For decades, the 60-40 portfolio was the gold standard. It was one of the best investments someone could make as they were heading into the retirement years. But there may be some unsettling times ahead for the 60-40 portfolio, and maybe also your portfolio if the past is any indicator of the future. Now, while this channel primarily talks about retirement planning, because that's one of the things we really focus on as a firm, I also serve as the Chief Investment Officer, so I think a lot about future and past market returns. And this week, there was this article in the Wall Street Journal, and it was entitled, "Your Set and Forget It 401k That Made You Rich. No More." And the author raises some really good points that I wanted to address. So in this video, we're going to look at why the 60-40 portfolio has done so well over the past 4 decades, why its future looks a little bit bleaker going into the next decade, and finally, what you can do about it. So throughout the past 40 years, you could have held a portfolio which is comprised of 60% of the S&P 500 and 40% of the total bond fund and done quite well. Now, much of the growth over the past 40 years was driven by demographic factors, which gave it a tailwind. You also had tech acceleration, and during much of that period, you had very cheap money. But demographics are shifting now in the opposite direction. We have an aging population, cheap money is drying up, and we also have a problem of a gigantic federal debt. As of this recording, the federal debt is $33 trillion. Now, in 2007, it was only $5 trillion, and it's continuing to grow at a rapid pace. And that's a giant issue because as interest rates rise, a larger and larger portion of the federal budget, which is already stretched thin, is now going towards paying the debt instead of supporting much needed services in our country. But we also have another risk that we face. If people stop clamoring for U.S. federal debt, and luckily right now, people still want to buy our debt, but if people stop clamoring to hold U.S. government debt, interest rates could go even higher. So that's a bit of our current situation. But now let's take a step back and look at the conditions that ended up making the 60-40 portfolio work so well for so long. During the late 1970s and early 1980s, we had runaway inflation. And so finally, to break the cycle of runaway inflation, Paul Volcker, who was the Fed chair at the time, raised the overnight interest rates to 19%, which is just incredible to think about in hindsight. So you had 19% interest rates, but what that did was that finally broke the cycle of inflation. It slowed everything down and allowed the economy to come back in sync. But the other thing that we don't talk about a lot is it also set up a 40-year bull market in bond prices. And I have another whole video that talks about how bond prices move inverse to interest rates. So as interest rates go up, bond prices go down. As interest rates go down, bond prices go up. So if you have interest rates at 19% and then they go down over the next 30 to 40 years, that drives bond prices up. And so you had, over the past 4 decades, you had a period where interest rates were coming down during much of the time, which was driving the price of bonds up. But you also had a disgust kind of with the stock market. It hadn't worked out well for a while. And so the prices of equity, the price of stock was incredibly cheap. And so it was the perfect recipe for success for the 60-40 portfolio. Let me just put this in perspective for you. An investor who put $1,000 into a 60-40 portfolio in 1981, adjusting for inflation, had $18,728 by the end of 2020. And even more impressive, that portfolio would have only lost money in 5 of those years. Howard Marks, who's one of the brightest minds in finance, said in a recent memo to clients, he said, "You have to have been working for more than 43 years and be over the age of 65 to have seen a prolonged period that was otherwise," meaning a prolonged period where the 60-40 portfolio wasn't dominant. And so what it ends up developing is a very strong recency bias because it's the only thing we've ever seen. It's the only thing we've ever known. But things have not always been this way. An earlier generation had a completely different experience. In the mid-1960s, stock valuations were at their most expensive level in decades based on a cyclically adjusted formula devised by a Nobel Prize-winning economist by the name of Robert Shiller. You may have heard of him. So you had 2 things happen at once. In the 1960s, stock prices were at an all-time high and inflation began to rise. And as a result, a family that put aside, let's say, $1,000 at the end of 1965 in a 60-40 portfolio, and then came back to that same portfolio in 1982, so almost 20 years later, they put $1,000 in, came back 20 years later, and in real dollars, adjusting for inflation, they'd have $785. So they lost money during that 20-year return. And here's where things get scary. Stocks are still higher today using Shiller's valuation metric than they were in 1966. And we also have a real risk of inflation continuing to rise. And here's something else concerning. When stocks have been in the most expensive quintile of valuations, as they are now, they have produced a real return of just 2.7% on average. And that's not nearly enough to support the returns that many investors need to support their retirement. This is partially because much of the rise we've seen in the prices of large stocks is driven not by the growth of the company, but by an increase in the multiple that people are willing to pay for the company. So let me give you a very basic example. Let's say you have a donut stand and you make $1,000 a year in profit in your donut stand. So let's say someone comes along and they say, you know what? I like your donut stand. I want to run a donut stand. I'm going to give you a 2x multiple. I'm going to give you 2 times your profit to buy your donut stand from you. So they give you $2,000. But now let's fast forward in the future. Times have changed and someone comes along and says, you know what? I think you have incredible growth potential. So I'm going to pay you a 10x multiple for your profit. Now, instead of paying you $2,000 for your firm, they're going to pay you $10,000 for your donut stand. Same company. The company didn't grow more. The price that someone was willing to pay had just increased. That's the same thing we're seeing happen in the stock market. Now, that's not to say we haven't seen any growth, but the growth in stock prices has been driven more by the increase in multiples than the growth of the companies. And so that's part of the reason why the author of this article, when they're looking at a 60-40 portfolio, is a bit concerned about the stock side of the portfolio. The other side of the portfolio, though, is bonds. And bonds to some people look like more of a buy at these levels. There's a real risk that interest rates could continue going up. There's a number of things that could cause interest rates to go up. And so if interest rates go up, it's going to drive down the price of bonds even more and further erode the effectiveness of the 60-40 portfolio. So what is someone to do in this situation? Now, first, a shameless plug. But if you'd like a free portfolio review, feel free to schedule a quick call below and we can talk about what that would look like. Now, returning to what you can do. The author suggests that one of the things that we can do to prepare is by lowering our return expectations and playing defense. So instead of expecting to take a 4% inflation-adjusted return for your portfolio, you might think about taking a 3% return from your portfolio. But for many people, that's just not going to be possible. I would argue that a better answer is creating an optimized portfolio. So while the expected rate of return of a 60-40 portfolio, so 60% S&P 500 and 40% total bond market, is lower than the past, there are portions of the market that have a higher expected rate of return, including stocks with a cheaper valuation, commonly called value stocks, in both the US and globally. And long data sets show that given enough time, like the tortoise and the hare, value stocks tend to outperform. So here's a quick chart of some real return expectations from Research Associates, which is a large investment firm, about what their expected return for different asset classes is over the next 10 years. And while U.S. growth stocks are expected to have a real return of around 1%, value and international stocks have a much brighter future. Now, the issue is, and what you need to know, is all these are projections, and so you don't know. Growth stocks could continue to outperform over the next decade. And so you want to have a well-optimized portfolio that provides protection and a higher expected rate of return while doing your best to reduce risk so that no matter what happens in the market, you can continue to fund your retirement. I touched briefly on bonds in this video, and one of the reasons I just touched on it briefly is I have another entire video where I go much deeper into bonds. And so if you want to know more about how the bond market works, how bonds are priced, go ahead and watch that video now.